S&P 500 trading just shy of a record high. Our next guest sees some potential headwinds brewing under the surface as we head into September. Joining me now, Jeff deGraaf, Renaissance Macro's chairman and head of technical research. Welcome back. What are these problems we need to be aware of?
Well, I think it's really the characteristics of the market and the leadership. We've seen a distinct shift away from tech and towards more defense. I mean, we could get even more broad and say defense versus cyclicality. And it's happening right at a point where the seasonals tend to, particularly for an election year, tend to soften. So the September-October period during election years is pretty tumultuous. Whether that's for the election or not, it generally tends to be a pretty tough environment. But the other thing I think is important, Scott, is when we went back and looked at the first Fed rate cuts in every cycle, and there's been 15 since the inception of the S&P 500. You're talking about roughly a 50-50 shot at the market being up over the next 1 to 3 months. But I think what was really interesting in our study was that tech really takes it on the chin. Tech underperforms about 80% of the time after the first rate cut. So there is a decisive move towards defensiveness once you get that first rate cut. And usually that's because it's not one and done and the economy ends up being weaker than what the expectations are, and it requires additional fuel from the Fed to get things going. So I think we've got a little bumpy period here that we're staring right down the barrel at.
I would only suggest that maybe this time actually is different, dare I say, because how many of those periods in which you looked was the Fed cutting because they wanted to, because they could, not because they had to. They're just normalizing rates. Their rate, as I suggested yesterday, relative to where inflation is, just makes no sense. And the economy is just fine.
Well, the economy is fine as we see it today, right? But the data, remember, we're going to be getting data out 3 and 6 months from now that's really a reflection of where the economy is today. And I think that's important. The other part, too, and maybe this is what you alluded to yesterday, I did not catch it, which is the spread between the Fed fund and the 2-year right now is roughly 135 basis points. And that's a pretty good proxy for where the Fed should be, the policy rate versus the market rate. And that differential, when it's this inverted, and by the way, this is the most inverted it's been since 2007, right? And so that obviously was a policy mistake that undid a lot of leverage in the system. And I'm not saying that we have this housing crisis or the same pillars of sand that we had back then, but certainly there are areas of the market that probably need to be liquefied and will be because of this extreme. So my concern is actually, if this spread were 50 basis points, no big deal, right? But this is going to take 5 cuts from the Fed just to get us back on sides. And that means it's going to have to be pretty persistent and pretty aggressive. And I'm not sure the Fed's ready to do that. Clearly, they're on the right path and they're talking a good game, but we're going to really need to see some action to avoid some of this.
But what if I also suggested what was viewed as defensive in the past isn't necessarily defensive today? Utilities, for example, because of the power generation required for AI, maybe we're playing a little offense there in ways that we didn't before. And maybe in healthcare, where we thought these were defensive yield type plays, now we're talking about GLP-1s and we're talking about transformational change in healthcare like we are in technology.
I will say the data, so forget where we are today and this time is different, but the data is very clear, which is if I were to just use the history of the data, I'd be selling tech and buying healthcare. No doubt about it. That's, that really is a standout in terms of what happens historically around the initiation of a Fed easing policy. So whether that's because they're more defensive and less prone to revenue swings, unlike what you see out of tech, I'm not sure. My gut says it's probably something. We could start stacking on some of the Ozempics and some of the new technologies that we see around healthcare on top of that. But I do think that there's probably an underlying bid because of the consistency that you see in the defensive nature of healthcare. I would just add as well that healthcare looks the least attractive in the U.S. It looks most attractive in the APAC Pacific Rim, even in Europe. It looks better than it does here in the U.S. So I actually look at that as a bullish phenomenon for the U.S. because you've actually got some pull horses that are stronger in front of us than the horse that we're riding right here.